Welcome to Deep Dive into Finance, where we demystify the complex world of finance. Today, we're going to delve into a topic that might sound intimidating at first, but is actually a fundamental concept for anyone navigating the investment landscape. We're talking about dollar cost averaging, or DCA for short. It's a simple yet powerful strategy that can be a game changer for investors, particularly those who are just starting out or those seeking to mitigate risk over time. Regardless of your investment experience, understanding DCA can provide you with a valuable tool to better manage your investments and potentially increase your returns. It's an approach that stood the test of time, proving its relevance and importance in the ever-changing financial world. So, without further ado, let's uncover the mystery behind dollar cost averaging. Dollar cost averaging, or DCA, might sound like a fancy term, but it's actually a simple concept. Imagine you're going grocery shopping. Instead of buying all your groceries in one go, you decide to spread out your purchases over several weeks. This way, you're not affected as much by any sudden price hikes. Dollar cost averaging works in a similar way, but with investments instead of groceries. At its core, DCA is an investment strategy that involves regularly buying a fixed dollar amount of a particular investment, regardless of its price. So, instead of dropping a lump sum into an investment all at once, you spread that investment out over a period of time. Let's take an example. Say, you want to invest a total of $1,000 in a particular stock. Instead of buying $1,000 worth of that stock all at once, with DCA, you would maybe invest $100 each month for 10 months. What's happening here? Well, when the price of the stock is high, your $100 will buy fewer shares. But when the price of the stock is low, that same $100 will buy more shares. Over time, this can result in you paying a lower average cost per share than if you had invested all at once. By using this method, you're essentially avoiding the risk of investing a large amount in a single investment at the wrong time. It's like a safety net that helps reduce the impact of market volatility on your investment. You might be wondering, why not just wait for the right time to invest all at once? That's a strategy known as timing the market, and it's notoriously difficult to do successfully. With DCA, you don't need to worry about timing the market perfectly. Instead, you're smoothing out your investment over time. In essence, dollar cost averaging is a strategy to reduce the impact of volatility by spreading out your investments over time. Now that we know what DCA is, how does it work in practice? Well, imagine you have a plan to invest $1,000 each month into a certain stock, ETF, or mutual fund. This regular investment is the core principle of dollar cost averaging. You're not trying to time the market or buy at the lowest point. Instead, you're just committed to investing a specific amount regularly, come rain or shine. So, let's say the price of the investment is $50 per share in the first month. Your $1,000 would buy you 20 shares. If the price drops to $40 per share in the next month, that same $1,000 would nab you 25 shares. And if the price jumps to $100 the following month, you'd only buy 10 shares with your $1,000. Now, let's pause for a moment. You might be thinking, wait, I'm buying fewer shares when the price goes up. That doesn't sound like a good deal. But remember, the goal here isn't to buy as many shares as possible. It's to average out the cost per share over time. By investing the same amount every month, you're automatically buying more shares when prices are low and fewer shares when prices are high. Over time, this can actually lower the average cost per share of your investment. Let's go back to our example. Over 3 months, you've invested $3,000 and bought 55 shares. So your average cost per share is not the highest price you paid, nor the lowest. Instead, it's somewhere in between at about $54.55 per share. And that, in a nutshell, is the magic of dollar cost averaging. It's a simple and disciplined investment strategy that can help smooth out the volatility in your investment portfolio. Of course, it doesn't guarantee profits or protect against losses, but it does offer a systematic approach to investing, regardless of market conditions. So, by investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high, thereby averaging the cost. Like any investment strategy, dollar cost averaging, or DCA, has its pros and cons. Let's start with the advantages. First up, simplicity. DCA is a straightforward strategy that doesn't require constant market monitoring or timing. All you need to do is decide how much you want to invest and how often, and then stick to your plan. No need for complex calculations or economic predictions. Next, risk mitigation. By spreading out your investment over time, DCA reduces the impact of short-term market volatility. This means you're less likely to be hit hard by a sudden market downturn because you're not putting all your money in at once. Thirdly, DCA promotes discipline. It encourages regular, consistent investing, which can lead to significant long-term gains. By committing to a regular investment schedule, you're less likely to be swayed by emotions or short-term market fluctuations. Now let's talk about the cons. A major downside of DCA is the potential for missed opportunities. If the market is on a consistent upward trend, investing a lump sum upfront could yield higher returns than DCA. In a rising market, DCA can result in buying shares at increasingly higher prices, which might mean lower overall returns. Additionally, DCA can underperform in comparison to lump sum investing. This is primarily because the money that's waiting to be invested isn't growing. If you have a large sum to invest and the market is rising, holding back funds to invest later could result in missed growth opportunities. In conclusion, DCA is a strategy that offers simplicity, risk mitigation, and discipline. However, it's not without its drawbacks. It can lead to missed opportunities and underperformance in rising markets. As with any investment strategy, it's important to consider your financial goals, risk tolerance, and investment timeline before deciding if DCA is the right approach for you. While DCA is a great strategy for mitigating risk and promoting disciplined investing, it's not a one-size-fits-all solution. Let's see how dollar-cost averaging works in the real world. Imagine you're an investor who has decided to invest $1,000 into a particular stock each month. Let's say in the first month, the stock is priced at $50 per share, so you buy 20 shares. In the second month, the stock price drops to $25 per share. Instead of panicking, you stick to your plan and buy 40 shares with your $1,000. Next month, the stock price rises to $40 per share. You continue your strategy and buy 25 shares. If you've been following along, you'll notice that even though the stock price fluctuated, you were able to purchase more shares when the price was low and fewer when it was high. This is the essence of dollar-cost averaging. Now let's fast forward to a year later. You've invested $12,000 in total and own 385 shares. The average price per share you paid over the year is about $31. However, if you had invested all $12,000 upfront at the initial $50 per share, you would only own 240 shares. This demonstrates how dollar-cost averaging can actually increase your total number of shares in the long run, even when prices fluctuate, by taking advantage of those lower price points. Of course, the market is unpredictable, and this strategy doesn't guarantee a profit or protect against loss in declining markets. But it does show how sticking to a consistent investment plan, regardless of market conditions, can help you navigate those inevitable ups and downs. Remember, investing should be thought of as a marathon, not a sprint. It's about long-term growth, not short-term gains. And dollar-cost averaging is a strategy that can help you stay the course, even when the market gets rough. Through these examples, we can see how DCA can help smooth out the bumps in the investment journey. So, that's dollar-cost averaging for you. We've journeyed through the ins and outs of this financial concept, discovering how it can be a powerful tool in your investment arsenal. We've learned that dollar-cost averaging, or DCA, is a strategy wherein you invest a fixed amount of money at regular intervals, regardless of the market price. This approach helps to mitigate the risk of investing a large amount in a single investment at the wrong time. We've also explored the mechanics of DCA, showing how it works in real time, smoothing out the market's ups and downs over time. Furthermore, we've weighed the pros and cons, acknowledging that while DCA can help reduce risks and emotional investing, it may not always yield the highest possible returns. We've seen DCA in action, demonstrating how it can be applied in various market scenarios. Remember, while DCA is a powerful tool, it's important to consider your personal financial goals and risk tolerance before implementing this strategy. Thank you for watching, and stay tuned for more deep dives into finance.